This framework has been discussed and used by many famous investors. I would like to use Apple stock as an example to show you how Warren Buffett, our famous investor in this century or in the world, used this kind of idea to form his strategy. I presented here Apple EPS, the column line, from 2002 to 2025. As you can see, I also calculated the PE ratio of Apple in each year. So we use each year's ending price divided by each year's EPS. The PE ratio goes from 2004 all the way drop. Bottom is around 2015 and 2016. Then climb up until right now is Apple's high PE time around 30. So bottom time of PE is a little bit above 10. So I'll tell you the results. When Warren Buffett in 2016, he bought Apple at PE around 12. Well, in 2024, he sell Apple, which PE almost at its highest point, around 39. Why we call him the greatest investor in the world? Indeed, he bought at the cheap and he sold at high. Now we are at 2025 to look back. We thought, oh, this is really great timing of Warren Buffett. But when you are actually in 2016, maybe you and me will doubt about his decision. Because let me introduce the market situation in 2016. In 2016, Apple's share price in quarter one is about $25. And the EPS of 2016 is around $2. Using this price divided by EPS, you can see P ratio is around 12.8 times. So what is market in 2016? Implied Apple growth rate for his performance in the following times? We know it's low. However, how low can it be? Let's use our little calculator to work out. Now let's go back to calculator. We just input 12.8, the P ratio of Apple in 2016. Have a look. 6.02%. They say to justify a P of 12.8, the company just need to grow their earnings by around 6% annually for the next 5 years, assuming 10% discount rate. So this is quite low growth rate. Well, why market will have such a low expected rate? Because in 2016, the Chinese market of iPhone sales actually slowed down, and the Chinese phone competitors have dropped the price a lot, and investors start to worry about whether Apple can still sell the iPhone as he expected before. However, Buffett sees something different. He saw Apple's moat is around his ecosystem and sticky user experience. If you ever use Apple, you know it's really hard to switch to other platforms because the experience was designed so smooth, it just have no hassles. And at that time, 2016, Apple also launched their Apple Store, iCloud, and Apple Music revenue grow very fast with 20% annual growth, which become a strong driver of Apple's performance. Of course, we all know that Apple's brand power is super strong. Whenever he issued a new product, he could charge premium price like iPhone watch I'm wearing, the earphone. It's all top-end pricing and people still buy it. So the margin is high. Well, Buffett did his own research and must have forecast the earning growth of Apple is way higher than 6%. So his investment thesis is Apple is significantly undervalued. So when a stock is undervalued, what do? Of course, you buy it. And the rest becomes a history. From 2016 until 2023, Apple has delivered fantastic results. But indeed, 2016 market concerns are not untrue. It has a 10% drop compared with 2015 earnings. That showed why 2016 market really doubt about Apple, whether it can sustainable growth with high speed. However, Buffett win the competition, right? So he bought Apple in first quarter 2016, and along the way he keep adding. So Apple in the highest time around 2023 become the largest stock holdings in his portfolio. However, next strategy Buffett did is start to sell in quarter 4 2023 Apple. Well, let's have a look what is the market pricing Apple by then. 2023 market price of Apple is around 190 and earning per share reached around $6. Remember previous $2, so 3 times increase. And P ratio was around 30 times. Then if you input 31 into our calculator, it will jump out with around 29.5% growth. Market in 2023 actually pricing in Apple fast growth. Well, it looks like market finally come to Buffett's view. Apple is a fast growth company. However, Buffett start to sell in quarter 4 2023. The clear reasons has never been disclosed because Buffett still hold a lot of Apple shares, 22% of his whole holding. But the experts are explaining the main reasons behind it. First is valuation concerns because 30 times PE implied almost 30% fast growth rate, at least for next 5 years, according to our calculator. Then we know it's a very high target to achieve. So bar become higher. And secondly, in the mature market, Apple's market demand may be hard to increase very fast, 30%. Almost everybody got it who wants an iPhone. While China risk again, because China is actually second largest market of iPhone sales. So with the trade war, with a lot of uncertainties, the Chinese users may switch to the local made brand. So that is another sales pressure of Apple. All those uncertainties plus the concentration risk in 2023, Apple grows so much, it's already become over 50% holdings in total Buffett's portfolio. So that is quite a big concentration risk. To rebalance the portfolio, Buffett has to reduce his Apple shares and sold 635 million shares since quarter 4 2023 until 2025. Cashed in how much? $120 billion for him. So those are big, huge cash generation machine for Buffett. But he still hold 280 million Apple shares by the end of June 30th. So we can see there's 2 major learnings. First, the valuation is always a considering point. When it's high PE, market expect the company continues to grow high earnings. But is that feasible? You have to check the market situation and make your own judgment. Second, I learned from Buffett's operation is when a company grows so big and become a dominant part in your portfolio, maybe you should trim the position of the stock to cash in your profit. All right, now it comes to your challenge for this week. I want to use NVIDIA for this case to test your understanding of the topic. So please, first, to check out what is NVIDIA's current PE, you can Google, very easy to find. Then plug this current PE ratio into our PE implied growth calculator to figure out what is the market expected growth rate of NVIDIA in the next 5 years. Second question is, once you have this market expected rate, do you agree with this expectation? Then last step is based on your research to compare the EPS estimates from your own research with market implied growth rate to make your decision, are you going to buy or sell NVIDIA stock? I'll give you 3 minutes to do this task. All right, 3 minutes back. If you did your task correctly, you may see right now. Let me share my screen. If you check NVIDIA share price in Google, it will lead you to this share price chart, and underneath you have PE ratio 53. So we can use 53, plug into our little calculator. Now type in 53.5, calculate growth rate. Market is implying 45.8 annually for next 5 years for NVIDIA to grow its earning, giving a 10% discount rate. You now need to ask yourself, do you agree with this growth expectation? How do you research and form your growth expectation will be our next week teaching. And based on your growth expectation, we will make our decision. Should you buy or sell NVIDIA? Obviously, if the market implied growth rate is smaller than we expected growth, absolutely, even at current PE, the market price is still undervalued. However, if we say the estimated growth by our own research is lower than 45.8% growth, then probably it's overvalued, the current price. Or you say 45% growth for next 5 years, maybe about the right growth rate, then it's a fair value. If you still have NVIDIA, just hold it. So that is the decision-making tool that we introduced today. Now sum it up. To develop your own investment process, you will use calculator 1 to check what is driving your share price right now, EPS or PE expansion. And then secondly, always check the current PE, what are the expected growth rate embedded by the market price, so you can use that embedded growth rate compare with your own estimates. Next week, we're going to provide the third calculator for you to use your forecasted EPS growth to calculate the fair price forecasting. And with those 3 tools, you should be able to think like a professional investors, always analyzing companies based on fundamentals, the company business performance, and making the data-driven decisions. Okay, the key takeaway for today. I hope you learned how to use our P implied growth rate to interpret the results, then compare that with your own estimates to form your investment strategy. Finally, I want to go through the homework. We always upload weekly quiz. You can access this week quiz through this link. And then use the PE implied rate calculator for one of your stocks and make your decision to adjust your portfolio in stock track. And number 3, as I said at the beginning, This week, we published a podcast topic with AI and energy. We want to show you that currently, maybe the hottest investment ideas are around energy, how they can benefit from AI boom because energy powers AI. But our guest speaker, Joseph, also tell us AI actually empowers more efficient usage of electricity, the grid management, which give energy sector a new boost to reform themselves. So lastly, for linking, maybe you think, oh, we have a lot of resources. We made linking to be the one-stop shop where if you follow us, you can access to all the information easily. We have the link here, and we currently have over a dozen students follow. I am monitoring our linking and welcome you guys, give us comments. We share a lot of investment ideas and analysis using the real-time updates. So give you more ideas and applications on concepts and the tools we discussed during the class. Okay, that's all for today. See you next week.